Hello, everybody. I'm Dr. Surush Azizi, and today I want to talk about bond prices and yields. Let's get started. Let's get started with the definition of bonds and bond characteristics, and we can keep going from there. So, essentially, bonds are securities that they are called also fixed income securities. What does it mean? Each bond has issuer. The issuer of the bond is usually either a federal government or some maybe a state or a city or a corporation. But they issue these bonds, and the bond promises either a fixed stream of income or a stream of income that's determined based on a specific formula. For example, it can be T-bills rate plus 2%. And based on that, we call bonds fixed income securities. So if I want to just define the bonds is a security that obligates the issuer to make payments to holder of the bond over time. So there's an issuer of the bond and the holder of the bond, and the issuer of the bond has the legal obligation to uh, make specific amounts of payments over time. Each bond has something that we call it either face value or par value. It's payments to bondholder at maturity of bond. So each bond has a time limit. Yes, the end of that time limit is called maturity of bond. The issuer of the bond must give back the face value or par value of the bond to the bondholder at the time of maturity. And usually bonds have something that we call them coupon. Bonds annual interest payment per dollar of par value. That's called coupon rate. Not all bonds have coupons. Some bonds are called zero coupon bonds. So they pay no coupons, but they are sold at discounts and pays par value at maturity. Let me give you an example of this zero coupon bond. For example, there is this bond with par value or face value of $1,000, and it's good for 3 years. So it matures in 3 years, and it doesn't pay any coupon in the meanwhile, any interest in the meanwhile. However, right now you can buy it, for example, at 850. So you invest 850 for 3 years, you would get paid nothing. After 3 years, you'll get paid the par value, which is $1,000. So that's $150 would be your return on investments. Let's review a few bonds here together. So here, the first column is maturity, and these are from Wall Street Journal online, November 15, 2022. So we have different maturities here, November 15, 2024. So maturity in 2 years, in 5 years, November 15, 2027, 32 maturity in 10 years, 41 May 15, 41, and then this one, May 15, 41 again, and November 15, 44. So that's 22 years from the issuing bond, and all the way to November 15, 2051. Then we have this coupon 2.25, 6.15, 125, those things. What is that? That's the amount of interest rate that the issuer is obliged to pay that. So if the bond face value is $1,000, here for the first one, the issuer of the bond is obliged to pay, so on $1,000, $22.50. So 2.25% of 1,000 is 22.50. And here, the bondholder is obliged to pay $6 and 6.125%. And then it's so on $1,000 bond, it's like 61.25 cents per year. The one that's highlighted, that's a bond with maturity on November 15. The interest rate is 3% per year. So that means $30 on $1,000 bond. And then we have bid and ask. These are bid and ask prices. So when you want to buy a bond, you have to pay. So ask price is always a little bit higher than bid price. The gap between bid and ask is usually called spread. When you want to buy the bond, you have to pay ask price. When you want to sell your bond, if you want to do so before maturity, you can do that, but you will receive the bid price. The gap between these two is called spread, and like the money maker, the market maker would sell the bond at ask price to you, but if you want, they buy the bond from you at bid price. And then change, like it's how much it changed from last day, like from yesterday, and asked yield. So bonds essentially so for example, this one, the highlighted is has the maturity of November 15, 2044. But and it was issued November 15, 2022. So that's good for 22 years. Now, many investors don't want to keep the bond for 22 years. That's just too much. So they want to sell it sooner. If you want to sell it sooner, you can. However, uh, you may not be able to sell it at, like, let's say, 100% of the money that you paid. So it depends on the coupon rates that your bond has and the current coupon rate that the market has. For example, you bought a bond with 3% coupon per year. Now, assume that after, for example, 2 years, after 1 year, after some period of time, the prevailing interest rates, the market interest rate went up. Now, people have the opportunity, for example, to go and buy the bonds with 4% interest coupon payments in the market right now. So your bond, which pays only 3%, nobody likes it. Nobody wants to buy it. So if you really want to sell your bond, you have to sell it at a discount. How much discount? For example, $81 and $81.64 or $81.70. Yes. Uh, you're selling your bond at a discount, so the buyer has more incentive because they would receive only $3 on the coupon, but the fact that they pay less, that makes up for the coupon payments that they receive, and it's lower. Now, if the buyer buys the bond at this price and keep it until maturity, this is the yield. This is the average rate of return that they will see. So it's sometimes called yield to maturity. It means so YTM, yield to maturity. YTM or yield to maturity, or sometimes asked yield, they're almost the same thing, means that what's the yield, what's the rate of return to maturity? If you hold the bond until maturity, how much return per year you would realize. So let's talk about bond characteristics. We have treasury bonds and treasury notes. So we have treasury bills, notes, bonds. Treasury bills are usually good for 1 year or less. Treasury notes are 1 year up to 10 years, and treasury bonds are usually 10 years and higher. Now we have this fact that accrued interest and quoted bond prices. Quoted prices do not include interest accruing between payments dates. What does that mean? It means that if you buy a bond and then in the United States, bond usually pay interest every 6 months. But let's say, for example, you buy the bond after 5 months. So only a month from the time that you buy the bond, you will receive the interest, you will receive the coupon payment. However, the previous owner was holding onto that bond for 5 months and they didn't receive any interest for that 5 months. So you have to reimburse them for those 5 months that they were holding to the bond and they didn't receive the uh, interest, they didn't get the coupon payment. So that's called accrued interest. Quoted prices that we have here, they do not include the accrued interest. So if you want to buy the bond, the sale or invoice price of the bond amount that the buyer actually pays is the stated price plus the accrued interest. So in addition to the stated price, you have to also pay for accrued interest. Now, how do we calculate accrued interest or AI? We should not mix it with artificial intelligence. Is annual coupon payment divided by two? Why divided by two? Because bonds in the United States usually pay interest twice a year. Times days since last coupon made payment over days separating coupon made payments. The days separating coupon made payments is usually 133, 130, 184, 182, something like that. And days since last coupon payment, you got to see how many days has passed since the last coupon payment. So let's do one numerical example. A bond with par value of $1,000 makes semi-annual payments with a coupon rate of 6%. If 45 days have passed since last coupon made payment, what's the accrued interest? So accrued interest would be, first of all, annual coupon payment, which is so 6% of $1,000 is $60. Divide that by two is $30. So annual coupon payment is 60 divided by 2. This fraction is 30. And then multiplied by days since last coupon payment, that's given in the question, 45 days, divided by days separating coupon payments, which is 182, like almost half of the year, half of a year. So 45 divided by 182 times 30, that's $7.42. So when you buy this bond, not only you have to pay that asked price, in addition to that, you have to pay this accrued interest as well. Let's move on from bonds that they are issued by the government, by let's say their treasury, to bonds that are issued by different corporations. So here we have listing of corporate bonds. And on the first column, we have the issuer. The issuer can be like different companies like CVS, Meta, Morgan Stanley, MetLife, different things. Each bond has a coupon, is a symbol, and then coupon. So these are the coupon payments that they have, and each has a maturity. In addition to maturity, now this table has something called Moody's slash S&P. That's a rate. Those are two rating companies, Moody and Standard and Poor. And it means these companies, they try to rate the how safe these bonds are. So like the safer bonds have higher ratings, yes, like AAA, those things. And less safe bonds have lower rating, but so somehow when we buy these bonds, we care about these ratings because these ratings show us the probability of bankruptcy of this company uh, up until the maturity date. And if the company goes to bankruptcy, they don't necessarily have the money to pay you back for the bond that you bought. And so we have this and then high, low, last change, like so how much it went up or down, the highest daily price, lowest, last, change it from yesterday, and then YTM, yield to maturity. That's one of the most important things. I'm going to repeat what it means. YTM or yield to maturity means if you buy the bond at the price, let's say asked price, and you hold it until maturity, what's going to be your average return? Now, you might ask why on earth we buy a bond that the company might go bankrupt. What's wrong with the governmental bonds, with the bonds issued by the Treasury of the US? That's a very good question. So, of course, bonds issued by the Treasury of the United States, they are safer. They have the guarantee of the federal government behind them. However, in most cases, these bonds pay higher interest. And since they pay higher interest, some people have more incentives to buy these bonds rather than bonds issued by the federal government. So corporate bonds, we have many different kinds of corporate bonds. Bonds, for example, one of the most famous one is callable bonds. Callable bond means that the bond may be repurchased by the issuer, by the company that issued the bond at a specified price, at a specified call price during the call period. So there is a call period, and the company that issues this, they have the right to buy back the bond. And you, as the buyer, you have to uh, sell the bond to the company, and you will, of course, get paid the face value of the bond or call price that they have. So, as a compensation for this risk, what risk? The risk that you might be obliged to give away your bond anytime that the company wants. Callable bonds are issued with a higher coupons and promised yields to maturity than non-callable bonds. So here you're taking a little bit of more of a risk. You buy a bond that the issuer has a right to call it and buy it when they want. So you're taking this risk, you should get compensated for this risk that you're taking. So these are called callable bonds. The next type of bonds that we have, they are called convertible bonds. Convertible bonds, they allow the bondholder to exchange bond for specific number of common stock shares. So essentially, as a bond buyer, you have the right to convert your bonds to the equity of the company. There is something called conversion ratio, number of shares for which each bond may be exchanged. Now, let me give you an example. For example, you buy a bond at $1,000 face value and conversion ratio is 1 to 2, and the conversion ratio is 1 to 2, and right now the stock price is 400. So at 400 it doesn't make sense for you to convert your bonds to equity of that company. However, if stock prices go up from $400 to, for example, $600, then it totally makes sense for you to convert your bonds to two shares of the company and then in that case, if it is 600, that would be 1200 rather than $1,000. So essentially, these callable bonds, convertible bonds, they let you to convert the your bonds to the equity of the issuer. That 1 to 2, that's called something that we call that conversion ratio, number of shares for which each bond may be exchanged. So this benefit comes at a price, however. So you get the right to convert your bond to the equity of the company, the issuer company. However, it comes with a price. The convertible bonds offer lower coupon rates and stated or promised yields to maturity than non-convertible bonds. So you get the right to convert your bond to equity. However, the regular interest payments are less. We have another thing called putable bonds. Holder may choose to exchange for par value or to extend for a given number of years. So at the maturity, you can just either uh, exchange the par value. Uh, you can either just give the bond and get back the par value or extend it for a given number of years. That's one thing. Another one that we have floating rate bonds that the rate of the bond is not 100% fixed. It might go up or down. So coupon rates periodically resets. Commonly pays fixed dividend, floating rate preferred. So let's talk about something else that's very important. We call them preferred stocks. And what are they, preferred stocks? So preferred stocks, they have some characteristics of stocks and some characteristics of bonds. So the most important characteristic of the bond is that it's a legal document between the bond issuer and bond holder. And bond issuer has the legal obligation to pay the money to the bondholder no matter what. Yes. So no matter what, they have to pay. Otherwise, it technically, if they don't pay the bondholders, they are bankrupt. However, so they have to make the payments and they have to make it by specified time. However, for preferred stocks, it's a little bit different. In what ways? Preferred stocks, they commonly pay fixed dividends. So amount of dividend that, so you know that we know that some companies, not all companies, but some companies pay dividend to regular stockholders. Yes. Now here, preferred stocks, they also receive dividend, but it's a fixed amount of dividends. We also have something called floating rate preferred stock, which becomes more popular. But for the issuing firm, unlike bond interest payments, dividends do not normally. So they pay dividends to these preferred stockholders. However, the company legally is not obliged to pay that dividend if they don't have the money. If they have the money, then they have to pay it. But if the company doesn't have that money, they can just postpone dividend payments to preferred stock. And there's another characteristic that for the issuing firm, so interest payments that they have on bonds, that's tax deductible. However, for preferred stocks, they are not tax deductible. So, like bonds, preferred stock promises to pay specified cash flow stream. However, unlike bonds, the failure to pay the promised dividend does not result in corporate bankruptcy. So, if they have the money to pay the dividend to preferred stock, they will. If they don't have it, they don't pay the dividends. So, the dividends owed simply cumulative if they cannot pay. Common stockholders may not receive any dividends until the preferred stockholders have been paid in full. So now let's compare three different things. Yes, the bondholders, preferred stockholders, and common stockholders. So in the claim of preferred stockholders, they have lower priority than the bondholder, but they have higher priority than of common stockholders. So the way that it works is that the company must pay all the bond payments, bond coupons that they have to pay. After that, they have to pay the money that they owe for preferred stockholders. And after that, if anything is left, they are allowed to distribute the remaining money between common stockholders. So the priority of preferred stockholders is below bondholders, but it's above common stockholders. We also have other issuers. For example, we have state, local governments, municipal bonds. The best thing about them is that you don't pay federal government taxes. And in the state that issues these bonds, you don't pay the state income tax on them. So no taxes. And then sometimes federal agencies, they issue bonds as well. And the conception is that if they can't pay back the money they owe, the federal government is going to help them. We also have international bonds, which can be divided to two parts, foreign bonds and euro bonds. Foreign bonds issued by borrower in different country than were bonds sold. So dominated in the currency of the market country. Like if Toyota wants to publish bonds in the United States, so the bonds that Toyota publishes in the US, they are dominated in the currency of markets country. So Toyota is a Japanese company, but if they want to issue bonds in the United States, the currency of the bond must be US dollars. Now, we also have euro bonds dominated in currency different than of that of a market, usually that of issuing country. So let's say Toyota wants to sell bonds in Europe. So they can issue bonds in, for example, Japanese yen, or they can sell it in US currency. So the currency is different than the destinations, the market that they are selling their bonds at. And in many cases, in some cases, these foreign bonds and euro bonds, they pay higher interest rates than the regular bonds. Recently, we have had so many innovations in the bond markets. Let's talk about a few innovations, like about the terms of maturity. Bonds conventionally issued with maturities of up to 30 years, so 25 years, 20 years, 15 years, 30 years. Recently, some countries issued bonds by 50 to 100 years of maturity. And we also have something called asset-backed bonds. Yes, income from specified assets used to service debts. So They are backed by some, for example, collateral that can be, for example, building or different things. So we have pay in kind bonds. Issuer can pay interest in cash or additional bonds. We have catastrophe bonds or cat bonds. They are becoming more and more popular. What does that mean, these cat bonds? So essentially, for example, we have insurance companies that insures people in, let's say, Texas, Florida against hurricane. And if there's a huge hurricane that damages, let's say, 100,000 houses, and 100,000 houses, and each of them they get damaged $100,000 on average. So 100,000 times 100,000, that's $10 billion. The insurance company doesn't have that much money necessarily. For example, if an insurance company issues these cat bonds, and the buyer of the cat bonds usually receives higher coupon rates. For example, if regular coupon rates are 5%, then the buyer of these cat bond or catastrophe bonds, for example, they receive rather than 5%, maybe 9% interest rate. And if and for example, it's for 3 years. If in within those 3 years there is a huge hurricane in Florida in a specified location that damages houses more than specified limits, then the bond would be worthless. You're not going to receive your par value back. The insurance company, uses the par value of those bonds to pay for the damages that happen to the houses. So the insurance company is issuing these bonds and somehow transferring the risk from themselves to the bondholders. So when you buy this bond, you are hoping that that catastrophe will not happen. And if it doesn't happen, you would receive like higher interest rates. Yes. Index bonds, they are payments tied to general price index or price of a particular commodity. We have something that's very important. It's called Treasury Inflation Protected Securities or TIPS. TIPS are maybe the safest asset on this planet. The par value of these bonds increase with consumer price index. So who issues these bonds? The Treasury of the United States. And we can take a look at these bonds. If you go to a website called Treasury Direct, so treasurydirect.gov, and you can see this. So here on the saving bonds, and then the second one, Treasury marketable securities, and then tips, you can see here. We sell tips for a term of 5, 10, or 30 years. And you can buy these Treasury inflation protected securities tips from the Treasury of the United States directly. The website is treasurydirect.gov. And the par value each year goes up with consumer price index. So if one year we have inflation of like 5%, the par value of the bond goes up 5% as well. However, in addition to that, you receive like regular coupon payments. The coupon payments are usually like, let's say, 1.5%, 2%, 2.3%. It depends on the maturity, if it is 5 years or 10 years or 30 years. However, your original money is protected against inflation. That's a fantastic thing. It means that your bond is not threatened by inflation. If you buy regular bonds from Treasury, and if, for example, pays you 5% interest, your in this risk that if inflation is, for example, 7% and your bond pays only 5%, then you're receiving negative 2%. As a matter of fact, your real return would be negative 2%, almost negative 2%, because the money that you are receiving as interest doesn't even make up for inflation. But if you buy these treasury inflation protected securities, the par value each year goes up with inflation. And in addition to that, you receive, for example, some interest. So next slide gives us a very good example. The tips, they don't pay 4% interest payments, but if we assume for 1 second that they do, let's say you buy a bond with par value of 1,000 at time zero. After 1 year, we had 2% inflation. The par value goes up 2%. 2% of $1,000 is $20. So the par value at the end of the first year is going to be 1,020. And so you would receive 4% interest on the par value. So par value is 1,020. You would receive $40.80. Why these 80 cents? That 80 cents is the interest, like 4% of these $20. Next year, assume inflation is 3%. So here you would have that 1,020 times 1 point times 1.03. Why 1,020 times 1.03? 1.03 is that 1 plus 0.03. So you convert this inflation to decimals. 3% means zero point zero 0.03. And you multiply this par value by this points by this like 1 plus 0.03. So this is how we calculate, as a matter of fact, uh, the so let's say from end of year one to end of year two, what happens is this. You would receive, so you have $1,020, and then the par value would go up 3%. That means you got to multiply that by 1 plus zero point zero 0.03. That means 1,020 times 1.03, which is 150.60. That's going to be your par value at the end of year two. And the interest on that one, yes, 4% of that, so zero point zero 0.04 times this $1,050.60 is exactly $42.02. So the interest that you receive at the end of the second year is going to be $42.02. So this is par value at end of t equals 2, and then this is interest in we receive at the end of year t equals 2. 4% of the par value. So if if we have nominal numbers and we want to convert these nominal return to a real return, we have to use this formula. Nominal return is interest So nominal return itself is interest plus price appreciation divided by initial price. And we have almost the same formula for like bonds, for stocks. So in stocks, interest is dividends, and price appreciation is like how much the price of stock goes up, divided by initial investment. So that's always nominal return. And if you want to convert this nominal return to real return, you would say, for example, 1 plus nominal return over 1 plus inflation minus 1. For example, uh, if we have, so let me give you an example here. If we have, for example, nominal return 5%, inflation 2%, calculate calculate real return. Then all we have to do, so first of all, here do not put nominal return on inflation as percentage. You must convert them to decimals. So if I want to convert them to decimals, I would just do this. I would say, so it's 1 plus zero point zero 0.05 over 1 plus zero point zero 0.02, and then that would be equal to 1 over 1.05 divided by 1.02, and then that's equal to, just you make that division and you get your number. So 1.05 divided by 1.02, that's 1 point, and then we got to say minus 1 as well. Yes, so minus 1, and then this guy minus 1, and so this is 1.294 minus 1, which is 0.0294. Or if you want to mention that in percentage wise, we can just say that as a percentage, this guy is 2.94%. So this is how you calculate real return given nominal return. Now, next topic that we have is how we can we want to talk about calculating the, so we talked about these tips and how their nominal return goes up. Next topic that we have is super important topic, assets in finance and how we can calculate a price of a bond. In finance, an asset is defined as a sequence of cash flows. So assets at time t is just a sequence of cash flows like CFT, CFT plus one, CFT plus two, and those things. Yes. So valuing an asset requires valuing, therefore, this sequence of cash flows. So because asset is nothing but a sequence of cash flows, therefore, if you want to value an asset, you have to value this sequence of cash flows. Yes. So value of assets at time t is this function Vt of these all future cash flows, current and future cash flows that we have. Now imagine we have a series of cash flows that at time t equals 1, this asset pays S1, $1, S at time 2, S2, and then at time t it pays ST. Now we want to find the value of this asset. We have to convert these cash flows to present value. What does it mean? It means to convert them to the value that they have at times t equals zero. A dollar that we receive 10 years from now, 20 years from now, is not equal to a dollar that we have right now in our pocket. The money, there is a time value of money. There are so many reasons for that, but you can imagine this. For example, if you have a dollar in your pocket right now, you can invest it. For example, you can invest it uh, in stock market, in S&P 500 ETFs. You can invest it in uh, treasury bonds. You can invest it in tips. And for example, we can invest it in 5 year tip and it pays, the price goes up with inflation, plus you receive some cash. So you have investment opportunities. And if we say that your opportunity cost of capital for one time period is R, then CF1, which you receive after one period, how much is that value right now? That would be CF1 divided by 1 plus R. So an R is a positive number, usually like something like, let's say, and it's not percentage, it's in again in decimals. So it's going to be like usually something like 0.08, 0.05, those numbers, yes. But again, it means that you receive the money after one time period, you have to divide it by 1 plus R, and R is the opportunity cost of the capital for one period. Why do I say one period, not 1 year? Because periods can be 6 months or 3 months or even 1 month or 1 year. The money that you receive after 2 years, if you want to find the present value of that, you have to divide it by 1 plus R squared, and then so on and so forth. A bond has following stream of cash flows. It pays it pays C at time t equals 1, and it pays C at t equals 2, and it pays C at t equals t. So you buy the bond, you keep it for maybe, I don't know, 1 year, 5 years, 10 years, 30 years, something like that. And in each time period, it pays different things. For bonds, usually, periods are usually 6 months. So bonds in the US usually pay interest twice a year. And then, so, and pays par. So at the end of the investment period, you also receive the par value. At time t equals capital letter T, you receive the par value as well. Therefore, the bond value would be this C over. So it's the present value of all future payments that we receive. So these are all the future payments that we receive. The first one is after one period, so it's C over 1 plus R. The second payments that we receive is the coupon payments after 2 periods. So that would be C over 1 plus R squared, plus so on and so forth until the last coupon, which is C over 1 plus R to power T. But at the end, at the maturity, we also receive the par value. So it's going to be plus par over 1 plus R to power T. And for bonds, periods are usually 6 months. So if I want to rewrite this equation using sigma formula, so I can just, this part, which depends on only coupons, I can write them in this format. Sigma lowercase t equals from 1 to t, and it's coupon divided by 1 plus r. What is coupon? That's C, like C that we have is coupon, yes? It's a dollar value. And then par value. So both coupon and par value, these are dollar values. They are not percentages. They are not anything else. So T is maturity dates, like number of payments that we have, and R is discount rates. So they are called discount rates, or sometimes we call them uh, opportunity cost of capital. Yes, opportunity opportunity cost of capital. And maturity dates, it's not, to be honest, like the exact date. It means the number of payments that we have. Yes, so number of payments until maturity dates. So number of payments until maturity dates. So this one is a discount rate and this one is this. Okay. Now, this is the equation that we have. So it's bond price. Bond value is just sum of all of these bond payments, all of these, which we can write it in this sigma equation, and then par value divided by this 1 plus r to power t. Uh, if I use algebra, I can just convert this equation to this format. So bond price is coupon times annuity factor of R and T, which can be written as this format. So coupon times 1 minus 1 plus R to power negative T. And remember, 1 plus R to power negative T, it just means 1 over 1 plus R to power T divided by R plus par value times 1 over uh, 1 plus R to power T. So this is just this formula, but it's much easier. For example, if you have a bond that's good for 30 years and it pays coupons twice a year, then T would be 60. So you have to add up 60 numbers. It's a cumbersome task to do. So if you want to avoid that, you can just use this formula having T as 60. So this is the same formula, and let's do a few examples. The first example that I want to do is this. A bond XYZ pays $40 every 6 months for 3 years, par value of $1,000. If discount rate is 6%, calculate bond price. So the very first thing that I want to mention is that discount rate is 6% per year. So you got to divide it by two, which is going to be uh, so the very first thing you want to do is to say discount rate of 6%. That means R equals. So if I can write this in equation, it's super important to make sure that we know uh, R equals this 0.06 divided by 2. Therefore, R would be 0.03. Calculate the bond price. So this is what we want to do. And here, so we know that uh, coupons, or which is C here, is $40. And then it pays every 6 months for 3 years. That means T equals 6. Yes, we have 6 coupon payments. And then par value is 1,000. So I got this one, and an R is 0.03. All I have to do is to plug in these numbers into this equation. So it's 40 times 1 minus 1 plus 0.03 to power negative 6 over zero point zero 0.03 plus 1,000, which is par value over 1 over 1 plus r, 1 plus zero point zero 0.03, which is 1.03 to power 6. And then if you use a calculator, that gives me $1,054.17. Wonderful. Now we are going to do a few more examples like this because this is such an important topic. The next example that we have, before getting to next example, I want to introduce something to you, which is a financial calculator. Maybe the most famous financial calculator is BA2 Plus. Uh, for example, Texas Instruments makes it as well. Right now, you can buy it from Amazon. So for something around $40, but it has some really good features for all finance, accounting, students, even like economic or statistics students as well. But specifically for finance and accounting is super important to have this calculator. So if you are majoring in finance accounting, definitely I encourage you to get this calculator. But look at these five bottoms. We have N, I slash P, PV, PMT, FV. And using these bottoms, we can easily just do these calculations and we can just get these numbers. Yes. So how do we exactly work with this? So, in many exams, also, you're allowed to bring a financial calculator, and like CFA, you're allowed to bring a financial calculator. The way that we do is this. Like, if I want to solve exactly the same question, first you put 6 equals n. N is again number of time periods, which we had it at 6. And then for interest, which was R, I slash Y, we put it as 3, not 0.03. That's super important. It's 3. So financial calculators, you have to put this as percentage, not as decimals. 40 is each coupon payment. PMT stands for payments. And $1,000 is like the like the face value of the bond that we have. And then you click on you press the CPT compute bottom and then you press PV. And as soon as you do that, you get this negative 1054.17. And why is it negative? Because it's money outside, money that just the outflows are pocket. Like this is how much you have to pay for this. It goes out of your pocket. It's money out of your pocket. So whenever it's money out of your pocket, it's gonna have a negative sign. So let me see if I can show you how we can do this on this calculator. Uh, so let me see. So right now, okay, this is the best way maybe I can do. And then, so I'm gonna start the calculator with this. Okay, and then I'm gonna start entering these numbers. Let me just make this a little bit bigger so I can see it better. Okay, yeah. So we have these numbers. Let me see. The first number was how much it was. Uh, I'm gonna press 6 for, so I put 6 and then equal sign and then n. So 6n. And then after that, I'm gonna do this. I'm gonna 3 equals and then I slash y. And after that, so the payments that we had was how much? Each payment was, I believe it was $40, yes. So each payment was $40. So I'm gonna click on 40. So 40 equals and then PMT. And after that, 1,000 equals and then FV. So I imported all the numbers. All I have to do is to click on this CPT and then click on PV. And it gives me negative, uh, I'm not sure if in the you can read it backward or not, but it's negative 1054.17. So negative $1,054.17, which is exactly the number that we got here. So that's a fantastic thing. So here you can use a financial calculator to calculate these, or you can just use a regular calculator and then use this formula and do calculate it like regularly. There's also possibility that there's, for example, this website that you can go there. If you just Google financial calculator, the very first website is this calculator.net/finance calculator. Here you gotta, so we have these five bottoms. First of all, you gotta know which one is the one that you're looking for. So right now, for example, FB is the one that I'm looking for. So you put just all the numbers. N was 6, I/Y was 3, PV, uh, sorry, I made a mistake. We are looking for PV, yes, not FV. We are looking for PV. So here, number of period is 6, I/Y is 3, payments, they are $40, and future value is 1,000. So that's it. And then you just click on calculate. And you can see that it gives you negative 1054.17. And it also gives you this, yes, very cool table. But yeah, you just put this information there, you hit calculate, and it gives you the results. You can do this with on this website, or you can do it on financial calculator, or you can use it say, like a regular calculator and this formula that we had all over here. But again, if you're doing finance or accounting, this is $40 investment that you definitely need it. Another example calculates, so it's same, very super similar example. Just wanted to make sure that we get enough examples. Calculate the price of bond with par value of 1,000, discount rate of 4% annually, which pays $30 coupon every 6 months for 5 years. So you're gonna make sure that what are the numbers first. So par value is 1,000, so uh, par equals thousands. Coupons are $30. And then N, or capital T, or is 5 years, 6 months, every 6 months. So that would be 5 times 2, which is 10. And then lowercase r, discount rate is 4% per year. So that would be 4% divided by 2. So it's 0.04 divided by 2, which is 0.02. and you put all this data in this equation that we have, and you get this. So 30 times 1 minus 1 plus zero point zero 0.02 to power negative 10 over zero point zero 0.02 plus 1,000 times 1 over 1.02 to power 10, which is this. Now, now that we know how to calculate the price of a bond, let's talk about the relationship between bond prices and the interest rates that we have. What's the relationship between these? Prices of bonds, prices fall as market interest rates rises. Why is that so? The reason is this. When interest rates rise, your bond, which has currently is issued, is in your hand, your bond is not gonna enjoy those higher rates. If you want to, for example, sell your bond, either it's emergency or you just want to do another investment for any reasons, people are not going to buy your bond at the face value because they have a better opportunity. Interest rates, the prevailing interest rates are higher right now. Therefore, they're going to buy if you offer them at the par value, they're not going to buy it. They're going to refuse buying that. They're going to buy the bonds in the market with higher interest rate. So if you want to convince them to buy your bond, you have to offer them a discount. You have to sell your bond at a discount. Interest rate fluctuations are primary source of bond market risk. So if we are talking about so uh, for example, if we are talking about bonds that they are issued by the Treasury, then there's no default risk. However, there's this risk of interest rate fluctuations, and so that's the primary source of bond market risk. Bonds with longer maturities are more sensitive to fluctuations in interest rates. Why is that so? Imagine we have a bond that's good for only for 1 year. And then it has only two coupons, which one of them is in 6 months, another in 1 year. So, and after that, you receive the par value. So only two coupons would be affected. And after a year, for example, you receive the whole $1,000. So it's not going to be affected that much. Or if you buy a bond only for 6 months, yes, if you buy like a treasury bill for like 6 months or even 1 month. So after 1 month, you can renew your investments. But if you buy a bond for 30 years, then you are locked in for 30 years. And all of these payments that we talked about, they are locked in. You remember these C's that we had? They are going to be fixed numbers for 30 years. So if interest rates goes up and new bonds they are paying higher coupon rates, you're already locked in for 30 years, 60 coupons of lower value. Therefore, it's more sensitive to fluctuations in interest rates. Here, for example, we have this figure that shows us the inverse relationship between uh, bond prices and yields. Now, as you can see, this is price of the 30-year 8% coupon bond for a range of interest rates, including the 8%. At 8%, so horizontal axis is interest rates and vertical axis is bond prices. At 8%, so this is 5%, this is 10%, 5, 6, 7, 8. At 8%, the bond price is $1,000. However, if interest rate rises from 8% to 10%, the bond's price would fall from 1,000 to 810.71. So at 10%, the bond is sold for 810.71. And you can obviously see the inverse relationship between bond prices and yields in this downward sloping curve that we have. Here is almost the same thing, but it shows us the table. So in the last slide, we had only 30 years, but we have also a bond that's good for 1 year, 10 years, 20 years, 30 years. You can see that a 1 year bond, if interest rate goes up from 8% to 10%, still its price falls. However, only from 1,000 to $981.41. So only $19 on 1,000. However, a bond which is good for 30 years, maturity in 30 years, the price falls from 1,000 to 810, which is 19% fall. So that's a huge difference. When we do bond pricing, when you buy a bond, you have to pay the invoice price, which is flat price or the price of the bond plus accrued interest. And accrued interest, we can easily also calculate that. We saw how we can calculate accrued interest. We saw how we can calculate flat price with the financial calculator or just the formula. But also we can do this in Excel with this function called price. So price needs 6 arguments: settlement date. For example, you can imagine that as the date that the bond was issued, maturity date, annual coupon rate, yield to maturity, redemption value as percent of par value. So it's a percentage. And then the last argument is number of coupon payments per year, which is so redemption value as percent of par value is usually 100, and then number of coupon payments per year is usually 2. Now, let's switch to Excel and see how we can do this in Excel. Now, here we have a bond with settlement date of uh, November 15, 2022, and maturity date of November 15, 2044. So you can also make these numbers with this date function in Excel. So equals date 2022, comma 11, comma 15. But so we have this, and then we can see that. So this is this, and then annual coupon rate. In Excel, we put these annual coupon rates again as decimals. Unlike financial calculator, which was in percentage, in Excel is just decimals, so 0.03. Yield to maturity, again, if you buy the bond at the current price and hold it until maturity, what's your realized return? It's 0.04293 or 4.293%. Redemption value as percent of face value is 100, and then coupon rate is coupon payments per year is 2. So this guy is just price and then B4, B5, B6, B7, B8, B9. And if you want to calculate, for example, days since last coupon, you can just use this coup day BS and then B4, B5, and 2 and 1. And then here, coup days B4, B5, comma 2, comma 1, and it gives you this 2. So accrued interest is for this bond is 0 because days since last coupon payment is 0. Therefore, accrued interest is 0. But invoice price is just sum of these two: accrued price and like flat price and accrued interest. So sum of these two. We are going to mostly focus on this flat price. We already talked how we can calculate this accrued interest just by hand, or we can also use these Excel functions. But the most important thing is this flat price. Now, I have an example that we can just use that as to practice. Now, let's say this is from a screenshot of slide 2. And the example that we just did is this highlighted November 15, 2044. Let's use the same things and calculate the price, which is usually ask price. Price for November 15, 2051. So all I have to do is to just copy these information. When you copy, the formula is also would be copied. So I'm going to copy that and paste it right here. And I'm going to make the adjustments that I have to make. The settlement date would be the same thing. However, the maturity date would be different. The maturity date here would be, rather than 2044, it's going to be 2051. So I'm going to change that to 2051. And then the annual coupon payment is, rather than 0.03, is going to be 0.01875. And then the coupon payment is 4051, and these two are the same. So as soon as you do that, the flat price is 63.07, which is exactly this. Yes. So this is how you calculate a price of a bond uh, using Excel. Perfect. Let's get back to slides. And so we saw how we can value a bond using just a formula, using a financial calculator, and using Excel. Three different ways. Next topic that we have is yield to maturity, or as we show that is usually with YTM, yield to maturity. So what is this yield to maturity? One more time, let's define it. Discount rate that makes present value of bonds payment equal to price R. A better way to understand this, to feel this yield to maturity, is this. If you buy the bond at the current price, at the flat price that we just calculated that, if you buy it and you receive all the coupons until the maturity, what's your realized return? That's yield to maturity. Current yield is defined as annual coupon divided by bond price. And then we have premium bonds and discount bonds. Premium bonds are bonds selling above par value, and discount bonds are bonds selling below par value. So if we have if par value is 1,000, then a bond that's being sold for 1,200 is a premium bond, and a bond that's being sold for $700 is a discount bond. Now, let's do this. So let's switch gears to calculate yield to maturity. Suppose uh, an 8% coupon 30-year bond is selling at 1,276.76 and pays interest semi-annually. What average rate of return would be earned by investor purchasing the bond at this price? It essentially is asking yield to maturity. Yes. Essentially, it's asking a YTM. So what's the YTM? Now here, for this YTM, we can't exactly calculate this using a formula. The formula is the same thing that we had before. The formula is right here. So the formula is right here. Bond price equals coupon times this. However, it's much harder to solve this equation for R. So in this equation, we were solving this for bond price, but if you want to solve it for R, it's much harder. Therefore, we are going to use that using financial calculator or Excel. So let's do it with a financial calculator. Now, the way that we do it in financial calculator, again, N is 30-year semi-annually. That means N is 60. PV, again, it's money out of your pocket, so PV must be negative. If you forget this negative sign, everything else would be ruined. You cannot calculate this. So PV must be negative, and then payments, and then FV, and after. So out of these five bottoms that we have, four of them would be given, and then the fifth one would be asked to calculate for. And so this is in the heart of investment. We gotta know how to do this. I'm gonna do it twice. I'm gonna do it on financial calculator on this calculator that I have, and also we can do this using okay. So let me see and okay how we can. Hopefully you can see my calculator, but essentially I'm gonna do this. Just first turn on my calculator. Now it has all of my previous numbers. I'm gonna just turn it off and turn it on again. If I do that, everything is reset. Now I'm gonna just put these numbers. Again, you're gonna put the numbers first and then equals and then uh, what you wanna put. So 6 equals n. I put 60 and then I put equal, and after that 60 equals n, and after that I do oops negative 12. So I'm gonna put 1276.76. After putting this number here, then you must click on the negative sign or press the negative sign to make it negative. And after that, I put that as PV. Yes, right here at the bottom, PV. So that's PV. And then I put 40 equals payments. 40 equals payments. After that, I just put 1,000 equals FV. So that's last piece of information that I have to put there. Last thing that I want to do is to click on CPT and then click on y/i/y. And as soon as I do that, it gives me 2.999987. That's essentially 3. Yes. So this is the way that you get this numbers on a financial calculator. We can also use that website. Uh, So let's go back to that website and use that website. So here, what I'm looking for is y/i/y, and I can just put all of these numbers easily. So here, and or number of time periods is, let's take a look at the numbers one more time. And it's 60, 1276.76. Let's put them here. 60 present value is negative 1276.76, and then PMT is how much? Each PMT is $40. So let's put that there. $40 here, and then click on calculate, And as soon as you do that, it gives you this I slash Y, which is 3%. Wonderful. That's really good. And we saw how we can do it on Financial Calculator. We can do it right here on this website. And also, we're going to see that in Excel. Before doing Excel, we can do one more thing, one more example. Those of you who are into financial in real estate, this is one example in real estate. So suppose you buy a house for $200,000 and rent it out for 5 years for 1,200 a month. After 5 years, you sell it for $210,000. What's the average return? So 60 equals N, 5 years, 12 months a year. That's 60. 60 equals N. Negative $200,000 equals PV. 1,200 equals PMT. 210 210,000 FE, and then CPT I slash Y. That gives you 0.668. The interpretation of that is average monthly return is 0.668%. That's a relatively good return. It's per month, this return is not bad. Now, how can we do this in Excel? So let's switch to Excel, and we can see that in Excel. So here we have this example that you have the bond at the settlement date, January 1st, 2000, maturity date in 30 years, January 1st to 2030, annual coupon rate is 0.08, bond price. So here bond price is given is this much, $127, 0.676. The redemption value as a percentage of face value is 100. Coupon uh, payments per year is 2. Yield to maturity. So if you want to calculate the yield to maturity, here's the formula. Yield and then B3, 4, 5, 6, 7, 8. So again, we need 6 arguments inside here, and then you just do this. So in order to just practice this more, let's do this example. Again, this is from slide 4. It's a screenshot that I took from slide 4. I'm going to use this formula to calculate the yield to maturity. So just let's copy this and then paste it right over here. And let's adjust everything. So settlement dates would be here 11 November 15, and then year is 2022 it was, yes. And then maturity date is 11/15, and then maturity date is 2051. And then here the rate is annual coupon rate is so it's not 8%, it's 1875. And then the price is this 63 0.0750. So if I put all of this information, and then right here I can see, so we are looking for this yield to maturity, which is given in the last column. I can see it's 0.0405, which is exactly this, yes, 4.05%. This is in decimals, this is in percentage. This is how in Excel you can calculate yield to maturity. So far we talked about different kinds of bonds. We saw how we can value them, what's the formula, how we can use a financial calculator or that website or Excel to calculate the price of bonds, how we can calculate the yield to maturity. Now, remember those callable bonds that we talked about? We have something also called yield to call. Calculated like they're very similar to yield to maturity. However, there is a slight difference. Time until call replaces time until maturity. So in the past, we had time until maturity. Now here we have time until call replaces. So call price replaces par value. So rather than par value, we have something that we say call price. The company has to pay you that much. So premium bonds more likely to be called than discount bonds. And we're going to have this example about these callable bonds. Suppose the 8% coupon 30-year maturity pays semi-annually bond sells for 1150 and is callable in 10 years. So these are important numbers. 10 years semi-annually at a call price of 1100. So it's not the 1000. So call price replaces par value. So let's put all of this information here. Determines yield to call. So rather than yield to maturity, we have yield to call. So first of all, 20 equals N. Yes, why 20? 10 years to call price, and then it's twice a year. So 10 times 2 is 20. PV is negative 1150. It's money out of your pocket. Payments, they are 8% per year. So 8% per year, that's $80 divided by 2, $40. Uh, and then FV. So far FV has been 1,000, but now FV is 1,100 because it's a call price. And CPT I/U, that gives you 3.3217. Yes. That's yield to call. Next topic that we have is called realized compound return. Compound rate of return on bond with all coupons reinvested until maturity. So when you buy a bond, or when you buy even a stock, you can reinvest bonds, reinvest the payments that you receive in the same asset that you have. If you reinvest everything until maturity, then we are going to say that realized coupon return. So there's this thing called horizon analysis, which is analysis of bond returns over maturity, a multi-layer horizon, and it's based on forecast of bonds, yield to maturity, and investment options. There's always something called we always face something called reinvestment rate risk, because there is no guarantee that you're able to reinvest the coupons in a bond with same interest. So uncertainties surrounding cumulative future value of reinvested coupon payments. Now here we have, for example, two different bonds. They have both 10% return coupon rates. However, the reinvestment rates for the first one is 10%, reinvestment rate is 8% for the second one. Not investment, not the coupon. The coupon rate is the same for them. However, reinvestment rates is different. This one is 10%, this one is 8%. So let's say the bond is good for 2 years. Here you at time zero, at time one, you receive $100. At time two, you receive 1,100. Yes, like $1,000, the coupon plus this 100. Now that 100 that you receive after 1 year, you can reinvest it in 10%. Here, this 100, you can only reinvest it in 8%. Now this 1,100 is the same between these two. However, here is 100 times 1.1. So after second year, your 100 interest that you earned here would be 110. But here it would be 108 because the reinvestment rate is only 8%. So at the end of the whole project, here you're going to have 12, 11, 12, 10. Here you're going to have 12.08. So we talked about these things, yield to maturity, YTM, which measures average rate of return if the bond is held to maturity. Holding periods return is HPR, which is rate over particular investment period. And we talked about HPR, which depends on market price at the end of the period. Now, if we have two bonds with maturity in 30 years, so this is time in years, and then this is price as percent of par value. You can see that this one, like when there's 30 years to maturity, this one is way more expensive. This is the red one is 12% coupon. The navy is 4%. So at the beginning, the gap is really high, but as we get closer and closer to maturity, they converge to 100 because at the very end, you receive this. So, however, this one goes from up and then here. We have zero coupon bonds and treasury stripes. So zero coupon bond, they carry no coupons, yes. Provides all the time in form of price appreciation. So for example, you pay $850. After 3 years, you receive $1,000. That's zero coupon bond. Separate trading of registered interest and principal of security stripes. They oversees creation of zero coupon bonds from coupon bearing notes and bonds. Uh, so these are like some investors, they are more interested in these zero coupon bonds because they don't know, they don't want to deal with the amount that they would receive in the in between. So they want to just pay all of their money and then at the end of the investment get the money out. But okay. So built-in price appreciation on original issue discount bonds continues implicit interest payment to holder. What are we talking about? So let's say you pay $850 and then at the maturity you receive $1,000. That we call built-in price appreciation, which the fact that you spent $850 and now you're getting back $1,000. So this built-in price appreciation on original issue discount bonds. That's exactly like implicit interest payment to holder. So you don't receive anything in between, but that appreciation of your money from 850 to 1,000, that's like somehow the implicit interest that you receive. IRS calculates the price appreciation schedule to determine the taxable interest income for built-in appreciation. That's $150 that you receive, extra $150. IRS calculates that at the to determine the taxable interest income that you receive. So this shows the price of 30-year zero coupon bond over time at yield to maturity of 10%. If you have yield to maturity of 10% in 30 years, so here you're spending around I guess maybe $70 or something. And after 30 years at 10%, you receive like around $1,000. Yes. So it goes up around 13 times. This is very true. Like, let's say if you are doing 401k, it's something like that. Stock market on average pays like 11%, 12%, so a little bit more than 10%. But if you spend $1 in the stock market and you put it on your 401k with 10%, if you put, for example, around $70, whatever number is this. Uh, then after these years, you would receive $1,000. So around 13%, 14% more after 30 years. Investment grade bonds. So bonds that are issued by different corporations, they are rated by like rating agencies like Moody, and so rated. Not all bonds are called investment grade. Only certain of them rated BBB and above by S&P or BAA and above by Moody. That's called investment grade bond. Anything below that is called, they're called speculative grade or junk bonds. Rated BB or lower by S&P and BA or lower by Moody, or unrated, they are called speculative or junk bonds. Yes. So here we have bond ratings, Standard and Poor's, Moody's, and we have very high quality, speculative, and very poor. Default risk and bond pricing. Default risk determines determinants of bond safety. We want to talk about different determinants of bond safety. So in financial statement that companies have, we can find many of these things. Coverage ratio, company earnings to fixed cost. So earning that the company has in 1 year divided by the fixed cost that they have, that's coverage ratio. Second one is leverage ratio, debt to equity that they have. How much debt they have, how much equity they have. The debt to equity is called leverage ratios. Liquidity ratio, current assets divided by current liability. So we can say this, the higher coverage ratio, the higher is the quality of bonds. Leverage ratio, we want it to be low. Safer companies have lower leverage ratio. Debt to equity would be lower. Liquidity ratio, we want it to be high. Current asset divided by current liabilities. The higher this ratio, the lower is the probability of defaulting. Quick ratio is assets excluding inventories to liabilities. So higher this ratio, it's better for the company, safer the company is. Let's keep talking about these determinants of bond safety. Next one is profitability ratio, measures of rate of return on asset or equity. The higher is this profitability ratio, the safer the bond. Cash flow to debt ratio, total cash flow to outstanding debts. The higher this ratio, the better, the safer the bonds. And we can also put all of this information here and check these ratios for different companies. So you can see, for example, the first one is EBITDA over assets. What is that? EBITDA is earning before interest, taxes, and amortization. So essentially, some uh, measures of operating income that they have. If you divide that by number of assets, you see that with AAA, very safe companies, that's 12.3. However, for C rated bonds, that's only 4.9%. So it's way higher for AAA. It's not just for one company, it's just for average companies. For operating profit margin, so profit margin is 24.8 for AAA, 4.6 for C. EBAT, sometimes people call it EBITDA, EBITDA to interest coverage. Again, the higher that, the better. 12 for AAA, zero point 0.8 for C. Debt to EBITDA, uh, so that's 1.9 to company for AAA, And then, so here, these companies have a lot of debt to this EBITDA, and debt over equity, debt plus equity. So debt plus equity essentially is assets, and debt over debt plus equity means debt over total number of assets. So AAA companies, out of $100 that they have, $42.80 of that comes from debt. But for C-rated companies, around $80 of that, each asset that they have, around 80% of that comes from debts. Funds from operation divided by total debts for AAA, it's 40%. For C is only 5.7%. And retained cash flow over net debt for the first one is 32.3%. And then retained cash flow over net debts for C is only 6%. So you can see the huge gap, and you can see uh, the the way that it changes. It's very distinguished between these companies. Uh, Bonds, indentures, it defines contract between the issuer and the holder, the company or the government that issues the bond, and the holder of the bond. The bond bonds have like a subordination clause, restriction on additional borrowing, stipulating senior bondholders paid first in event of bankruptcy. So you buy a bond, and then if the company issues like way more bonds, then you as a bondholder wouldn't be very happy, because if the company goes bankrupt, then those all other bondholders are gonna just claim assets of the company. So you wouldn't be that happy. But with this subordination clause, you can have this that, hey, the senior bondholders, they have priority. In case of bankruptcy, the senior bondholders would receive the uh, payments first. Collateral, specific assets pledged against possible default. So if the company wants to default, there is a specific asset that's uh, is can be used as a collateral. And debenture is like bonds not backed by specific collateral. We can see here the yield spreads among corporate bonds. We can see that AAA rated versus BAA versus and then high yield. Like we saw, for example, in 2009, 2008, 2009, here they went up the interest yet yield spread. However, look at this for like high yields. Yes, it's really high. So these are spread between yields to maturity of bonds of different risk classes since 1997. So from 1997, you can see like the gap here. Yes, but and you can see that the riskier the asset, the higher the spread. Okay. We have a credit default swaps, which is insurance policy on default risk of corporate bonds or loans. Yes. So companies can buy, if you buy a bond, it's risky. Yes, there is a uh, risk of bankruptcy. Yes, you can go and buy this credit default swap. Yes, it's an insurance policy uh, that you can buy, and it's an insurance policy on default risk of a corporate bond or loan. So when you buy that, the insurance company tells you that, hey, if the bond defaults, we pay for that. So in 2008, this company, AIG, American International Group, they sold a lot of these CDCs, this credit swap defaults, in 2008. And then because of that, because many bondholders defaulted, then in 2008, this AIG's credit default swap portfolio, so which is insurance, yes, it's on a risky mortgage-backed securities. So they issued a lot of that. But when the housing market collapsed, AIG was forced to pay billions of dollars on these contracts, leading to credit rating downgrades and near bankruptcy of this uh, AIG group. So they sold a lot of these CDCs on mortgages, designed to hedge against borrower defaulting on a bond or loan. So the borrower, the company that issues these bonds, they might default on their bonds. Yes, they might go bankrupt. And you, as the buyer, usually not people usually don't buy it. Usually it's institutional investors, pension funds, they buy this. But they buy this to hedge against this default risk. Yield curve shows us graph of yield to maturity as function of term to maturity. And as maybe the other name for it, it's the term structure of interest rates. It shows the relationship between yields to maturity and terms to maturity across bonds. And then based on the expectations hypothesis, we have this hypothesis that yields to maturity, they are determined solely by expectations of future short-term interest rates. So let's see these yield to maturities, so yield curves. So here, horizontal axis is a little bit different than always. So here is 1 month, 3 months, 6 months. Then from here is years. So this is not regular horizontal axis, is logarithmic horizontal axis. So 1 month, 3 months, 6 months, 2 years, 5 years, 10 years, 30 years. So it's logarithmic horizontal axis. And then here we have flat yield curve. Here we have rising yield curve. Here we have something that we call inverted yield curve. And here we have something that we call hump shape yield curve. Yes. So what does this yield curve shows us? It's a graph of yield to maturity as a function of term to maturity. So here essentially tells us that the bond that's good for 30 years receives a little bit higher of interest than a yield a bond that's good only for 1 month. Here, it's inverted yield curve. Inverted yield curve means that, for example, a bond that's good for 30 years gets way less interest than a yield that's only for good for only 3 months or 6 months. And here it goes up and then it goes down. So if we suppose, let's talk about this. Let's solve this example to understand the yield curve better. Suppose that R1 is 8% and for 2 year investments, Y2, the return is 8.995%. Based on expectation hypothesis, what's the today's expectation of next year 1 year interest rates or ER2. So here we can solve this like this. So if you have $1 and you invest it right now for 1 year, and then after that year, so ER2 means today's expectation of next year, 1 year interest. So if you have $1, you invest it right now. You get $1 right now, the rate is this 1.08. And after that, whatever money you have at the end of 1 year, you invest it again here and you earn another R2. It's going to be 1 plus R2 times this, which is your initial money at the beginning of year 2. This is one option. Another option is that right now you invest your money in a 2 year investment. You lock in for 2 years. It's going to be 1 plus 0.08995 squared, which is just, if we calculate this and we calculate R2, then R2 would be 10%. This is break-even value is called the forward rate for the second year or F2. What does that mean? It means that like here, you invest right now, 8% right now, and then here, expected rates for the second year would be 10%. So if you invest $1 right now, at the end of the first year, you're going to have 1.08. And then if you multiply that by 1.1, then you get 1.188. Or you can just do investment of 2 years. 2 year investment with this percentage, you are going to have 1.188. The 2 year cumulative expected return in both cases would be 1.188. So if we have right now we have these two numbers. Yes, we have 8%, we have 8.995. If we have these two numbers, we can calculate the forward rates of the rates a year from now. So rates a year from now, we expect that to be 10%. So inferred short-term return on investment, we show that with ROI for future period makes expected total return of long-term bond equal to that of rolling over short-term bonds. This is the way that we calculate these forward rates, yes? So you have two options. Let's say you have $1 in your pocket and you want to invest it. You have two options. Either you can invest it for n years, or you can invest it for n minus 1 years. And after n minus 1 years, you can invest it for one more year. If you invested in n years, if you lock in your investment for n years, this is how much money you would have after n years, 1 plus yn to power n. If you lock in for only n minus 1 years, it's going to be 1 plus yn minus 1 to power n minus 1. And then from these two, you can find the forward year for year n. So forward year, let's do this example. Suppose that 2 year maturity zeros offer 2 year maturity zeros. It means the zero coupon. You don't get paid in the middle. It's a zero coupon bond. It offers yield to maturity of 6%, and 3 years zero coupon bond have yield of 7%. What's the forward rate for the third year? And the answer would be 9.02. How did we calculate this? Let's do this together. So let's say I have $1 in my pocket, and let's see how we can do this. If I have $1 in my pocket and I want to calculate this, this is going to be the answer. So either I can invest this for 2 years and then another year, or 3 years. If I invest it in for 3 years, this is going to be my return. Yes, so my return would be 1 plus. What's the 3 year investment rate with zero coupon? 7%, 0.07 to power 3. And this would be equal to 1 plus, what's the investment rate, return rate for 2-year contract? Only 6%. So 0.06 and then to power 2. And then this, however, after the second rate, I'm not going to just put my money in front of my eyes and look at it. I'm going to invest it one more time. So that's going to be 1 plus, and this guy would be F3. And from this equation, we can easily find this F3. So all I have to do is to calculate this left side. So left side would be 1.07 to power 3. 1.07 to power 3, which is 1.225225043. And then right side is, so here I gotta say 1.06 to power 2. That's 1.1236 times then this guy. And then from this equation, I can easily find this 1 plus F3. So 1 plus F3 would be just this guy divided by this guy, which is 1.225043 divided by 1.1236. You make that division, you get 1.09 0 28. Let's call it 0.3. And then so F3 would be 1 minus this guy minus 1, which is just point 0903 or 9.03%. So what is this? This is forward rates F3. It means somehow expected rate of return for like invest 1 year investment 2 years from now. Expected rate of return for 1 year investment 2 years from now. Now, it's something like that. However, it's not exactly that. So investors demand risk premium, yes, investment demand uh, risk premium on long-term bonds. Yes. Why? Because liquidity premium is the extra compensation investors demand for holding longer-term bonds with greater price risk. If you are holding 30-year bond versus 10-year bond, you demand expect a higher return because you are locked in for 30 year rather than 10 year, and you are demanding higher interest for that. Yes, that totally makes sense. So liquidity, so you demand that, and because you are in danger of interest rates more, and it's this liquidity preference is the spread between the forward rate of interest and the expected short rates. So these Fn and ERN, they are not exactly the same. There is a gap between them. So here, in this example, we calculated F3. It's not exactly expected rate of return of 1 year investment 2 years from now. It's F3 forward year 3, and the gap between these two, Fn and ERN, is called liquidity premium. Liquidity premium can be shown here, yes. So it's forward rates minus ER, and it's like this, the red one minus this navy one. So the gap between these two is called liquidity premium. And here we can see that there's this 10-year treasury and then 90-day T-bills, and then there's this gap between them. So for the most part, 10-year treasury pays higher return than 90-day T-bills. Both of them are super safe. Both of them are issued by the Treasury of the United States. However, when you are locked in for 10 years, you have a risk of interest rate fluctuations. And since you are getting this risk, you have to be compensated for this risk. Therefore, although both of them are super safe, here you are getting this the gap between these two. The difference shows the liquidity preference that we have, and for the most part is positive. However, sometimes it can be also negative, specifically when interest rates hike. Then sometimes 30-year, 10-year treasury would be less than 90-day treasury because the market expects the rate to go down, and then therefore 10-year doesn't pay that much, but 90-day pays higher interest rates. So this just shows the 10-year treasury and 90-day treasury and the difference between them. That's sometimes like 1973 and 1980, it was a negative number. That concludes this chapter. Thank you very much, everybody, for listening, and have a wonderful time. Thank you.